When it comes to choosing the best options strategy for any market situation, the key factor to focus on is implied volatility. It's the cornerstone of successful options trading and the critical element that can make or break your trades. Let's start with the basics. Implied volatility, or IV, is a measure of the market's expectation of future volatility. In simpler terms, it's how much the market thinks the price of a stock or index will move. Over time, I've proven that options pricing tends to be overstated because implied volatility often exaggerates the expected movement of a stock or index. This is why understanding implied volatility is more about a process of elimination rather than selection. Strategy always trumps direction in options trading. To be successful, I need to be on the right side of volatility. So, how do I choose the right strategy? It comes down to this. When implied volatility is high, I need to be more of an option seller than a buyer. High IV means the market is expecting large price movements and options are priced higher. Selling options in this environment allows me to capitalize on the market's tendency to overestimate future moves. But this doesn't mean I can't buy options. In strategies like credit spreads or iron condors, I might buy options as part of the overall strategy. The key is to be a net seller when IV is high. Conversely, when implied volatility is low, I might consider buying options. However, even with low IV, the edge still leans towards option selling. Buying options is usually for hedging or when I have a strong directional conviction. At the income option, 95% of the time, we focus on option selling. This is where we have a consistent edge and can generate reliable income. The remaining 5% of our strategies involve option buying, primarily for hedging purposes. To be crystal clear, our approach revolves around option selling because that's where we see the most consistent success. Now, the most important question I ask myself is implied volatility relatively high or low? This is crucial when I start looking for trades. The best way to determine this is by using the IV percentile, which shows how the current IV compares to its past levels. For example, real estate prices are relative. What's expensive in one area might be cheap in another. Similarly, the IV percentile helps me assess whether implied volatility is high or low for a particular stock. Let's look at 3 different stocks: Apollo Tyres, Hero MotoCo, and DLF. While their actual IV numbers might be similar, their IV percentiles could differ significantly. For instance, Apollo Tyres might have the lowest IV percentile, indicating that its implied volatility is relatively low compared to its past. This could make it a better candidate for buying options rather than selling. Using IV percentile scaling helps me decide which strategy to employ. As implied volatility increases, I become more aggressive in selling options. For example, low IV might lead me to choose debit spreads, while high IV might drive me towards more aggressive strategies like straddles or strangles. Finally, I always consider my overall portfolio balance. I assess whether I need more bullish or bearish positions to maintain neutrality. For example, if I already have several bullish trades, I might choose a bearish strategy to balance my portfolio. The bottom line is that implied volatility is the #1 factor I focus on, followed by my directional bias based on what my portfolio needs. Strategy always trumps direction, and understanding implied volatility is the key to making the right decisions. Remember, success in options trading comes from being on the right side of volatility. Stay focused, stay disciplined, and always prioritize strategy over direction. Thanks for watching, and don't forget to subscribe for more insights from the income option.